Happy Thursday, everybody. Welcome to another episode of China Update, where we discuss leading political, economic, and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. But first up, a quick correction from the last video. On Tuesday, we profiled AXCP Ventures. Though the US ticker symbol was correct, there was a typo with the Canadian ticker symbol. The correct ticker symbol is AXCP, not AXAP. My apologies for the error. I know some folks went looking for this with the wrong ticker symbol, and it caused some inconvenience, so my apologies especially to you. I've put the correct ticker symbols as well as links, information, and disclosures in the description below of today's video for anyone who wants to check that company out, that opportunity out, and do their due diligence. Now, with that said, let's move into today's episode. And first up, we need to discuss China's economy. China has cut its benchmark lending rates for the first time this year, as policymakers step up efforts to revive sluggish economic growth. On Tuesday, the one-year loan prime rate, LPR, was trimmed from 3.1% to 3%, while the five-year LPR, crucial for mortgage pricing, was lowered from 3.6% to 3.5%. Although the 10 basis point reduction is modest, analysts say it sends a strong signal of Beijing's commitment to stabilize market expectations and stimulate investment and consumption. Lower LPRs are expected to ease borrowing costs for businesses and households, with a typical 1 million yuan mortgage seeing savings of over 50 yen per month. Of course, the move also puts pressure on banks already razor thin and in some cases profit-losing margins. The move follows earlier action by the People's Bank of China, which reduced its 7-day reverse repo rate to 1.4% and emphasized a, quote, moderately accommodative, end quote, monetary stance. In tandem, China's largest state-owned banks have slashed deposit rates for the 7th time since late 2022. For the first time, the one-year deposit rate has dropped below 1%, now standing at just 0.95%. The 2-year rate fell to 1.05%, and 3- and 5-year rates were cut to 1.25% and 1.3% respectively. Current account yields are now a mere 0.05%. While these cuts aim to preserve banks' lending margins amid easing cycles, they leave savers with limited options for returns, raising concerns about capital flight and pushing investors toward riskier assets. The policy balance between stimulating growth and preserving financial stability remains delicate, and it is not clear whether this balancing act has been successfully executed. Only time will tell. Meanwhile, China's budget deficit surged to an all-time high in the first 4 months of 2025 as Beijing ramped up spending to cushion the economy from intensifying trade tensions with the US. According to US-based Bloomberg calculations based on official Ministry of Finance data, meaning the actual situation could be even worse, the broad deficit widened to 2.65 trillion yuan, $367 billion from January to April, over 50% higher than the same period last year, and the largest ever recorded for the period. The sharp increase underscores how fiscal stimulus was deployed aggressively to offset the impact of a steep hike in US tariffs, which rose to a peak of 145% in April before the truce was reached earlier this month. Government outlays rose 7.2% to 11.97 trillion yuan, led by infrastructure investments and social programs. Spending from the government fund budget used for capital projects soared, with central authorities increasing their expenditures by 75% year-on-year, and local governments by 16.6%. An incredible increase. Revenue, meanwhile, showed signs of stabilizing, the only bright spot in the data. Total fiscal income declined just 1.3% from a year earlier, narrowing from steeper drops earlier in the year. Tax receipts rebounded slightly in April, rising 1.9%, thanks largely to stronger individual income tax collections. Interest payments on government debt were the fastest growing category of general budget spending, up 11% year-on-year. Expenditures on social security, employment support, and education also saw notable increases, signaling efforts to shield vulnerable populations from economic headwinds, though hundreds of millions are still very much suffering from the economic slowdown of recent years. Quote, government spending was accelerating while revenue shows signs of stabilization, end quote, said Zhao Pangxing, a senior strategist at ANZ Bank. adding, quote, "The need for expanding fiscal deficit in the middle of the year has declined." End quote. However, the rate of debt accumulation is already at eye-watering levels, and if the trade war with the US and others re-escalates, that changes everything. And indeed, this brings us to our next development. Despite a temporary easing of trade tensions between China and the United States, Beijing appears to be maintaining, if not reinforcing, its export restrictions on rare earth elements, raising questions about the durability of the so-called Geneva Truce and how the US will respond. Under the terms of the 90-day agreement announced last week in Geneva, Switzerland, China pledged to suspend or remove so-called non-tariff countermeasures it had imposed on the US since the 2nd of April. That promise, interpreted by Washington to include newly imposed export restrictions on 7 key rare earth minerals, has come under scrutiny. US Trade Representative Jamison Greer, speaking on US-based Fox News this week, confidently asserted that China had agreed to remove those restrictions. Quote, "If they don't do these things, we're going to be back in a different situation," end quote, Greer warned, adding, quote, "But I expect they'll remove them." End quote. So far, however, there is little evidence to suggest Beijing is complying. Industry insiders report tighter implementation and heightened oversight of rare earth shipments. Export data appears to support that view too. While Chinese exports of rare earth elements surged to a 9-month high of 5,600 tons in March, possibly as overseas buyers rushed to stockpile, April shipments fell slightly to 4,785 tons, though still up 4.8% year-on-year. Niche metals like metallic scandium saw even sharper gains, suggesting strategic hoarding may have taken place before restrictions were imposed. The continued controls underscore China's strategic leverage. The country refines about 70% of the world's supply of 20 key energy-related minerals, according to the International Energy Agency's latest Global Critical Minerals Outlook. 15 of those minerals show more price volatility than oil, with 55% of these critical materials now under some form of export restriction globally. Supply chain security is increasingly vulnerable to geopolitical risks. As Washington considers its next steps, analysts warn that renewed escalation over rare earths could quickly unravel the fragile trade détente and further destabilize global supply chains for technologies critical to both economic and military power. Of course, we're now in a more unstable period of history, with the US-China Cold War deepening, with implications that will affect all of us around the world. If you want to be on top of all the developments related to this new US-China Cold War, as well as the most up-to-date and significant developments on China generally, make sure you're subscribed to China Update, hit the bell notification icon, and you will be. And if you're getting some value from today's episode, don't forget to hit the like button. Let's continue. This week, Taiwan President William Lai Ching-te marked his first year in office with a speech that, in a notable departure from tradition, made no direct reference or mention of mainland China or cross-strait relations. Instead, Lai focused on Taiwan's democratic transformation, stating that the island, quote, "was once the country with the world's longest martial law period, but now we are a beacon for democracy in Asia." End quote. He credited past generations for resisting authoritarianism and laying the foundations for a free and open society. Though the speech was widely interpreted as restrained, Lai addressed China-related issues in follow-up remarks to reporters and in a televised interview with Japanese media. He emphasized Taiwan's commitment to peace, reiterating that, quote, "peace is priceless, and in war there are no winners," end quote, but added that Taipei would continue to bolster its defenses, quote, "whilst our pursuit of peace is sincere, we must not be naive," end quote, he said. In his interview, Lai accused Beijing of seeking to reshape the global rules-based order and warned that an invasion of Taiwan would disrupt global supply chains. That's putting it mildly. He stressed that Taiwan's defense posture, particularly its development of drone capabilities, was rooted in national security and industrial needs. Lai also expressed a desire for deeper cooperation with democratic allies, including Japan and the United States, to deter aggression. Beijing, however, reacted sharply to Lai's overall posture. A spokesperson for China's Taiwan Affairs Office accused Lai of pursuing, quote, separatist Taiwan independence, end quote, under the guise of democracy and engaging in, quote, two-faced tactics, end quote. He'd announced Lai's appeals to foreign allies and attempts to frame cross-strait tensions as part of a broader ideological divide between democracy and authoritarianism, declaring, quote, these tactics are entirely futile and doomed to fail, end quote. Notably, there has been no immediate military response from the People's Liberation Army, PLA, despite past instances where assertive rhetoric from Taiwanese leaders triggered live-fire drills or shows of force around the island, though it is early days and I will update you if this does change. Analysts noted that Lai's decision to omit China from the speech may have been a strategic gesture aimed at de-escalation, following a more assertive inauguration address 1 year ago. However, his reaffirmation of Taiwan's democratic values and subtle warnings about China's ambitions leave little doubt about his underlying message. Taiwan will not yield. And finally for today, Contemporary Amperex Technology Co. Limited, or CATL, the world's largest electric vehicle battery maker, made a triumphant debut on the Hong Kong Stock Exchange on Tuesday of this week, surging 16% and raising 35.7 billion Hong Kong dollars, 4.6 billion US dollars, in the year's largest global listing. The strong showing defied geopolitical headwinds, including a Pentagon blacklist and growing US-China trade friction. Shares opened at 236 Hong Kong dollars and closed at 306 Hong Kong dollars, significantly outperforming CATL's Shenzhen, that is the mainland, listed stock, which rose a much more modest 1.2%. The surge reflects robust investor confidence in the company's technological edge and global growth potential despite geopolitical uncertainties. CATL, which supplies batteries to Tesla, Volkswagen, Ford and Mercedes-Benz, holds a commanding 38% share of the global EV battery market, more than double that of its closest competitor, BYD Co., at 17%, according to SNE Research. Last year, it posted revenues of $50 billion US and net income of $7 billion, underscoring its dominance in the fast-growing EV sector. The Hong Kong offering was priced at roughly 17 times current earnings, and analysts see further upside. Jefferies Johnson Wan called it a no-brainer buy, projecting a 50% upside driven by robust earnings and attractive valuations. Investor demand was strong, with options trading volume exceeding 34,000 contracts, an all-time high for first-day activity in major Hong Kong listings. Despite CATL's inclusion on a US Department of Defense blacklist over alleged ties to the Chinese military, a charge the company denies, but every man and his dog knows is likely the case, Western banks, including JP Morgan Chase and Bank of America, supported the listing. The successful float doubled Hong Kong's year-to-date IPO proceeds and could encourage more companies to go public. CATL plans to use the proceeds to fund its ambitious global expansion, including a $7.6 billion US push into Europe, where battery margins are higher. The company has introduced cutting-edge technology, including a battery capable of charging 520 kilometers of range in 5 minutes and delivering 1,500 kilometers on a full charge. Let me just check what that is in miles for our North American viewers. That is 932 miles. Chairman and founder Robin Zhang, now among China's wealthiest individuals, hailed the listing as, quote, a new milestone in our mission to drive the global zero-carbon economy, end quote. At the listing ceremony, he forecast that 50% of China's truck market would be electric by 2028, up from just 14% in early 2025. Electrification of heavy trucks, he said, could cut transportation costs by 35% per ton-kilometre versus petrol-powered vehicles. That bold prediction signals an impending disruption in the global trucking industry, with traditional manufacturers like Volvo, MAN and Daimler facing intensified Chinese competition, mirroring trends already seen in the passenger car market. Investor concern ahead of the listing centered on the impact of US President Donald Trump's tariff policies. CATL factories are reportedly running at 98% capacity as clients rush orders ahead of the 90-day truce's expiration. Quote, after the Geneva Agreement, the phones haven't stopped, end quote, said Zhang, adding, quote, it's been non-stop calls to ship immediately. End quote. In addition to cementing CATL's presence in global capital markets, the blockbuster IPO pushes Hong Kong's total listings for 2025 past $22 billion, according to Bloomberg Intelligence. The listing also demonstrated that high-quality Chinese firms, or at least firms that investors globally believe to be high quality, still attract global capital, even amid turbulent times. Whether markets are wise to do so, of course, remains to be seen. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a good Thursday, and I'll see you for another episode tomorrow.